Okay, imagine this. You buy the safest thing you possibly can, right? A government bond. But what if buying it actually guaranteed you'd lose purchasing power?
Sounds completely backwards, doesn't it?
It really does. But it's not just theory. Smart money, well, they think this is where we're actually heading. And it points to this massive shift, potentially, of capital into totally different places.
Mm-hmm.
So today, we're doing a deep dive into exactly that idea.
Mm-hmm.
The U.S. government heading towards what they call negative real yields.
Right.
Basically, the return on a 10-year treasury, once you factor in inflation, goes below zero. You want to unpack what that really means for you, your portfolio, the whole market, especially because, well, the thinking is this could be back around May, June, July next year.
Yeah, and it's important to remember this isn't just, pulling ideas out of thin air. We actually saw this happen during the COVID era.
Right.
And the pathway for it to come back seems clearer now. It looks like some form of yield curve control. You'd have the Treasury and the Fed basically working together, buying up bonds to keep the yields down.
So keeping borrowing costs capped for the government.
Exactly. And if you understand that mechanism, it really helps connect the dots to the bigger picture. What's shaping markets right now. Everything from the day-to-day drivers to these huge longer-term shifts we expect next year.
Okay.
So our mission today really is to give you a clear, kind of actionable handle on these really powerful forces because they could genuinely be game-changing for where capital goes.
All right, so let's unpack that long-term endgame playbook then, this whole idea of an age of negative real yields. Just to make sure we're all on the same page, can you break down what real yield actually means and why is it so disruptive if it goes negative?
Absolutely. So real yield is pretty simple, actually. It's just the return you get on a U.S. Treasury bond after you subtract inflation.
Okay.
So if that number is negative, it means holding the bond to maturity guarantees, like literally guarantees. You lose purchasing power. Your money buys less at the end than when you started.
You're basically paying the government to hold your money while it loses value.
That's it. And that's critical because it just completely breaks the traditional logic, right? Bonds are supposed to be safe, preserve capital.
Mm-hmm. And this sounds pretty dramatic for the U.S., negative real yields, but it's not totally new globally or even here recently, is it?
No, not at all. We had negative real yields here in the U.S. from the COVID period right up until about May 2022.
I remember that.
Yeah. And while it's still kind of novel for the U.S. system overall, it's actually pretty standard in places like Japan. They've had explicit yield curve control for years.
Right.
And the thinking is this becomes official U.S. policy maybe around May, June, July of next year. Probably lines up with the new FOMC chair coming in.
And the mechanism is that yield curve control again, Treasury and Fed working together.
Yep. Yield curve control. So the Treasury issues bonds at the low rates it wants, and the Fed steps in as the buyer, basically, to make sure those rates stick. They essentially monetize the debt.
Okay, so if I'm an investor, a rational one anyway, and I know holding government debt means losing purchasing power, where does my money go? Is this that free assets idea?
Precisely. Yeah. Rational investors, institutions, they just won't accept guaranteed losses on supposedly safe assets.
Well, makes no sense.
Right. So that's the core driver. It forces this flood of capital out of government debt and into other things. That's what ignites this endgame playbook.
And you call them free assets because...
Well, free in the sense that their upward move becomes almost inevitable in that environment. Capital is effectively pushed into them. Now, the public story, the narrative isn't fully there yet. There's still, short-term distractions, debates about rate cuts.
Yeah.
But this underlying policy shift, that's the fundamental thing that's going to shape asset performance for, well, years to come, we think.
Okay, so let's talk about where that capital floods, the big beneficiaries of this huge shift. First one that comes to mind.
Yeah.
Gold. We always hear gold, safe haven. What's its link to real yields historically, and what are you thinking in terms of potential moves?
Gold has this really well-defined inverse relationship with real yields. It's quite clean historically.
Yeah.
When real yields go down, gold tends to go up. Now, that relationship seemed to break down a bit around July 2022. But the expectation is it comes back and potentially comes back with a vengeance once this new policy is really locked in and real yields start that sustained move lower.
And the forecast?
We could be looking at another maybe 30%, maybe even 40% move up from where we are now.
Wow. Okay. And then there's Bitcoin. It's definitely evolved, hasn't it? Beyond just pure speculation. How does it fit into this whole store of value idea when capital's fleeing bonds?
Yeah, Bitcoin, I mean, it's still seen as risk on by many, but increasingly institutions, retail, they're looking at it as a store of value too. So
Hmm.
as capital flees those negative yielding bonds, it's pretty inevitable that a chunk of it finds its way into crypto's main asset.
It's a direct result of this.
Right.
What did you call it? Macro financial repression?
Exactly. Macro financial repression. Governments, central banks, basically manipulating markets to keep their borrowing costs super low. And that represses returns on safe stuff, forcing money into riskier assets, inflating those instead.
So what's the Bitcoin forecast looking like in that scenario?
It's pretty substantial. We're thinking something on the order of 40%, maybe even up to 60% gains for Bitcoin.
Okay, that's significant. Now, what about stocks,
Yeah.
equities, S&P 500?
Yeah.
It feels a bit counterintuitive, maybe, that stocks would benefit from all this, but you're saying lower real yields are like fuel?
Yeah, exactly. It can feel counterintuitive, especially because a sharp drop in yields initially might cause some jitters, some market anxiety.
Sure.
But ultimately, dramatically lower real yields act as powerful fuel for equities. It pushes valuations higher.
How does that work exactly?
Well, think about it this way. The risk-free rate you get from bonds is really low, or even negative, right? So the extra return you expect for taking the risk of owning stocks, that equity risk premium, it looks much, much more attractive by comparison.
Ah, okay, so the relative appeal goes way up.
Precisely. That premium widens and it just sucks capital into equities. We've seen this pattern before. And then you add in the fact that it's the Fed and the Treasury working together this time, suppressing yields, that makes it an even more potent catalyst.
Makes sense. So the S&P 500 could be a major beneficiary too.
We think so, yes.
So with all this capital moving around, yields being pushed down, what happens to the U.S. dollar in all this?
Well, the natural consequence of these policies is likely a weaker U.S. dollar.
Right.
It's always important to remember the euro is like 60% of the dollar index basket. So the euro's performance is a huge variable there.
Right.
But the underlying pressure from U.S. policy suppressing its own yields, well, that's likely going to be bearish for the dollar overall, makes its yields less attractive globally.
Okay, so that's the long-term picture in this endgame scenario.
Yeah.
But we have to trade the market we're in now. So let's shift gears. What are the key drivers, the short-term things we need to watch as of, say, August 2025? Let's start with the dollar and yield spreads.
Yeah, it's actually quite interesting right now. The clearest macro driver for the dollar seems to be the yield spread between the U.S. 10-year Treasury and the German 10-year Bund.
Okay, the U.S.-Germany spread.
Exactly. And that spread basically reflects what the market expects from monetary policy in both places. It's fallen back into this really tight correlation with the dollar.
So when the spread narrows.
The dollar falls with it, yeah. It tells us that monetary policy expectations are really front and center for the market right now. So the takeaway is probably not the best time to be aggressively shorting the U.S. dollar or major USD pairs. While this correlation holds so tight, you'd be fighting that immediate driver.
Got it. Okay, moving over to crypto. You mentioned a fascinating story in the altcoin market. What's this synthesized altcoin indicator you're tracking and what's it showing?
Right, the synthesized altcoin indicator. We put this together combining stablecoin dominance, which tells us how much cash is sitting on the crypto sidelines ready to deploy, and Bitcoin dominance, which shows Bitcoin's market share. When Bitcoin dominance falls, it often means money is flowing from Bitcoin into alts.
Okay.
So we were watching the combined indicator, looking for a break below the 66% level. And as soon as it broke, boom, it was like an elevator down for the indicator. That was basically the starting gun for a really powerful altcoin rally.
But there's a twist this time.
Yeah, that's the interesting part. Unlike some past cycles where everything just ripped higher, this feels like a much more selective alt season. Capital is flowing, but it's concentrating on specific, stronger projects. So traders need to be a bit more discerning, Can't
Sure.
just buy anything.
And did that indicator point to a specific leader in this selective rally? Who's been the main beneficiary?
Oh, absolutely. Ethereum. It's been the primary beneficiary, no question. It's smashed through its key resistance level, around $3,960, with some serious momentum.
What kind of numbers are we talking?
Get this. Over the last 6 weeks or so, Ethereum's market cap has jumped by about $100 billion. And just in the last 4 days, it's up another, 16%? It's pretty staggering. And typically what happens is money flows into the leader, like ETH first, and then it starts to trickle down into other large cap alts, like, say, Solana. That creates that selective effect.
Interesting. Okay, looking broader now at the main stock indices, it feels like a tale of two markets, a real divergence. What are the leaders and the laggards telling us?
Yeah, there's definitely a clear split. Your leaders are the S&P 500 and the Nasdaq Q. They're pushing up near all-time highs again. Looks like they're poised to attack 6,500 for the S&P and maybe 24,000 for the Nasdaq Q.
Strong momentum.
Very strong. Probably best approached on an intraday basis for now, displaying that momentum. But then you look at the laggards, like the German DAX or the Dow Jones, the US 30. They've really made no meaningful progress since July, just chopping sideways. So that suggests maybe some caution if you're thinking about swing trades in those markets.
So a market focused on specific growth areas, maybe, not broad strength.
Seems that way. And a really critical point for all the indices is probably going to be the Jackson Hole meeting at the end of the month.
Always a big one.
Always. Often creates a lot of volatility, could give us some fresh clarity heading into September.
Good heads up.
Right.
All right, let's get into some specific market color for August 2025. Any FX trades catching your eye this week?
Yeah, for FX traders, the pound dollar, GBP USD, after the last CPI print, the London fix created a pretty clean setup, actually.
Okay.
There's this tight range basically between 1.3482 and 1.3525. So for a day trader, if you get a confirmed break and then a retest of either side of that range, it offers a potential maybe 70, 80 pip trade. A nice little scout for short-term players.
Okay, useful. What about oil? Often a big mover, lots of headlines. What's the picture there?
Oil is honestly pretty uninspiring right now, just chopping sideways mostly.
Yeah.
Can't seem to find clear direction, not much strong buying interest.
Just stuck.
Yeah, pretty much. It's frankly just so lame at the moment. So taking a bullish stance, that's kind of off the table for us until at least next month. It's just not finding a bid above the key resistance levels.
And the geopolitical stuff?
Yeah.
Iran?
Even those catalysts, like the rally we saw earlier, links to Iran and the Strait of Hormuz, that seems to have fizzled out mostly. Feels like the market's either priced it in or is just more worried about demand right now. A flare-up probably wouldn't drive prices much higher from here.
Okay. And lastly, the yen. Always a bit of a puzzle. What's going on with USD-JPY versus, say, GBP-JPY?
Yeah, the yen's tricky. USD-JPY, that's usually tied pretty closely to U.S. Treasury yields, right?
Right.
And with U.S. yields looking like they might roll over again, the implied trend for USD-JPY is also down. We'd be targeting maybe 146, 144, eventually 142.
High.
But the conviction there is super weak because U.S. yields themselves are just chopping around, zero momentum, makes it hard to commit.
Okay.
But then you look at other yen pairs, like pound yen, GBP JPY, or Aussie yen, AUD JPY, they're actually strong.
Really difference.
Because the Bank of Japan is actually hiking rates, trying to deal with strengthening inflation over there. And that's fundamentally negative for the yen itself. So it just highlights, again, the selective market, right? Certain pairs respond more to their own domestic stories than the broader global trends sometimes.
Very interesting. Okay, now, you mentioned a crucial warning signal, something every trader needs to have on their radar, this TPS curveball. First off, what are TPS?
Right, TPS, they're Treasury inflation-protected securities. And the key thing is they're inversely correlated with real yields.
Okay, so when TPS prices go up,
real yields go down. Exactly.
and there's a specific level you're watching.
Yeah, the critical level on the TPS chart is 111. Right now it's hovering around 110.114, so pretty close. And that raises the big question.
Yeah.
Why is 111 so important?
Okay, why is it so important? And what's this about a stagflation trade?
It's important because that's likely the point where bond traders really go big on the stagflation trade, meaning they'll want protection from inflation, which TPS offer, but at the same time, they'll be betting that economic growth is going to be terrible, maybe hinted at by that weaker jobs number, the NFP print, back on August 1st.
Ah, okay. Bad growth, high inflation, stagflation.
Exactly. So if, or maybe when, TPS crosses that 111 level, that could be the signal for a pretty significant risk-off dip in stocks.
A dip before the main event.
Potentially, yes. This isn't just a minor wiggle. It could be the precursor dip. The market signal that comes before the Fed fully steps in with those endgame policies, the yield curve control.
So that TPS chart is critical for navigating the transition.
Absolutely critical, because it could signal that short period where falling real yields are initially seen as negative by the market, causing that dip before they then become the powerful fuel for the big parabolic rally later on.
Yeah.
Understanding that signal, navigating that transition, that's going to be absolutely key.
That is a critical point. Wow. Okay, so thinking about traders navigating all this, let's touch on psychology and strategy. First, dealing with losses. Everyone goes through it.
Oh, yeah. Losing money, it's universal in trading. It really is just part of doing business. It's not some reflection on you, your status, your intelligence.
Easier said than done sometimes, though.
Oh, for sure. I remember early in my career, I hit this really rough patch, felt totally defeated. But looking back, that experience, talking it through with mentors, it helped me see it's just part of the game. It's feedback.
So how do you move forward?
You lean on your community, you analyze what went wrong objectively, and you actively work on building that emotional resilience. And like we always say, having the right market environment nailed is infinitely more important than anything else.
Focus on the conditions, not just the individual trades.
Exactly. Be prepared for the conditions you're in. You won't be right on every single trade. Nobody is.
That's a great reminder. Okay, so looking at this long-term end game, possibly starting next year, but also this potential big dip first, the billion-dollar question is, should investors just sit on their hands and wait for that dip?
Yeah, that's the question everyone asks. My clear answer is no. I personally wouldn't wait.
Why not?
Well, the big problem with waiting is, first, that potential drop could still be, 8 months away? Maybe longer, maybe shorter. And second, trying to time the exact bottom perfectly. It's basically impossible.
You risk missing the boat entirely.
You risk missing huge opportunities while you're sitting on the sidelines waiting for a dip that might not come when or how you expect. The better approach, I think, is to trade the market you have now. Be active, manage risk, but participate.
But keep that long-term end game in mind.
Absolutely. Keep it firmly in the back of your mind. And the ultimate confirmation, the ultimate tell for that massive trend higher kicking off.
Who is it?
It's when you actually see the Fed actively buying bonds under yield curve control, and crucially, when you see real yields start that sustained track lower. That's the green light. That's the signal for those really big parabolic moves we talked about.
Okay, so as we start to wrap up this deep dive, it really feels like we're juggling two narratives here, doesn't it?
Absolutely. That's a great way to put it. On one hand, you have this extraordinarily bullish long-term outlook for assets like Bitcoin, gold, equities, all driven by this coming era of negative real yields, explicit government policy. That's the multi-year end game we're trying to position for.
Right.
But on the other hand, in the short term, right now, the market demands selectivity. It demands patience. August is proving pretty choppy, like we discussed with the diverging indices and the mixed signals.
So what does all this mean for you, the listener, moving forward?
Well, keep your risk managed always. Stay nimble. Have your watch list ready for those high conviction setups when they appear.
And keep an eye on Jackson Hole.
Definitely. Jackson Hole at the end of the month could inject some volatility, maybe give us some clarity as we head into September. The opportunities, they are building. We're definitely entering a really dynamic period for the markets. It's going to be an awesome ride, I think.
It certainly sounds like it. So maybe a final thought to leave everyone with. Given that a guaranteed loss on government bonds seems to be on the horizon, how might your definition of safe haven assets need to evolve in the coming years? Something to think about.